If you have two cells that you want to merge under the Home tab, find this uh, two-sided arrow, merge and center. Okay, I'm going to divide everything by total assets. This is only for 2 years. If you wanted to go back a little bit more, you should actually go download the financial statements for 10K for 2022. That'll give you 22 and 21. So you could collate things together. I don't know why they're not doing it in one filing, but they're not. Yeah, you could read off a lot of stuff. For example, total current assets, about 30% of Walmart's assets are in current assets, or their cash and cash equivalents, not much. Not much receivables. That's normal for a retail company. In fact, most of Walmart's receivables would be uh, basically receivables from credit card companies. When you charge something to credit card, it's recorded as a sale right then, but it typically takes anywhere from 5 to 7 business days for the company to actually get the cash. But at the time, financial statement is filed, that still is the receivable. Inventories, that's an important number. Yeah, let's do the same thing for Kroger. Uh, Oops, that's not what I wanted to do. Escape. Oddly enough, let's see. Oh, Kroger has more receivables, and their inventory is also a little bit less. That's the total current assets. So on and so forth. Okay. We'll use other ratios to make comparisons of things like inventory and stuff, but then, we could say other things. For example, total liabilities. For Kroger, liabilities are about 80% of assets. In fact, that's also known as the total debt ratio, which we're going to come back to. For that is total liabilities. As I said, there is no standard, but we can figure it out. As you know, total liabilities are total assets minus total equity. It's about 64, 65. So that means Walmart is using a little bit less debt compared to Kroger. And they're not much debted companies. Now, generally, we're going to talk about other types of ratios. We can kind of classify them into four types. Short-term, what was it? Debt ratios, short-term solvency ratios. Solvency means to what extent you're able to meet your obligations. Long-term solvency ratios, asset efficiency ratios, profitability ratios, like there is more, growth ratios, and price multiples. These two are of, similar nature, but they speak to different audiences. Short-term solvency ratios speak to short-term creditors. Long-term solvency ratios speak to longer-term creditors. Asset efficiency ratios tell you to what extent you're using your assets efficiently. If you can generate a lot of sales using as little assets as possible, you're very efficient. And typically we call these turnover type ratios. The profitability ratios, these are basically things like profit margin, your net income as a ratio of your revenues, return on assets, return on equity. So your ratio of your net income to your assets, that's in a sense how much money you're earning in an unlevered kind of viewpoint. Viewing all of your assets both with your own money. Return on equity is to what extent you're making money on your investment. One caveat with these, since assets are booked at the historical cost minus depreciation, that doesn't necessarily reflect true return on investments, but we kind of start with that. Growth ratios We're going to look at two of them, the internal growth ratios and sustainable growth rate. Internal growth rate basically says if nothing about the nature of your company changes in terms of your asset efficiency and profitability, what is the maximum amount of growth you could have using only internal resources without borrowing any more money or issuing new equity? Sustainable growth rate would be to what extent you could grow as long as you could borrow more, provided you keep your debt equity ratio the same. So these are internal and sustainable growth rates. And they're kind of important. For example, let's talk about price multiples first. These are ratios of price per share or market capitalization, which is price per share multiplied by number of shares divided by some quantity, either per share or total. For example, you can calculate price earnings ratio by dividing share price with earnings per share or by dividing market cap with total earnings. Give you to kind of figure out what these kinds of things mean.